You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. My name is Brian Overby, the author of The Options Playbook, and I'm going to be your host here for about the next 20 minutes on Options Playbook Radio. I'm back. Well, me and the powers that be have decided to get the band back together, and we're going to start doing Options Playbook Radio going forward. And when we say get the band back together, it's not that hard to do considering it's a one-man band. And then when you throw in the fact that it's not even a band that plays music, it's just a podcast, we've just basically decided that we're going to start throwing out a bunch of option strategies. And the good news is that I am no longer associated with a brokerage firm at this point in time. I started a company called Options Playbook Incorporated, which will give you a little bit more freedom on the podcast. You know, nothing's still meant to be a recommendation, but we'll be able to be a little bit more forthright with our forecasts on Options Playbook Radio. And I don't want to downplay all of the work on the back end. Options Insider will be doing the production and editing of all of the podcasts. And for that, I do thank everybody at Options Insider. And with that said, let's light this candle. Today's date is August 30th, 2024. And I want to kick off this revamp of Options Playbook Radio by looking at nothing other than a butterfly, which has always been one of my favorite strategies to talk about on Options Playbook Radio, if you go all the way back and look at the archives. But this butterfly is going to be a little bit different. We're going to be looking at the VIX index, the volatility index, good old VIX, and we're going to do a seasonality trade in that usually, if you look back 20 years on the VIX, the most volatile months of that index, time and time again, are the months of September and October. We are obviously at the end of August, so I've decided to modify a butterfly to try to take advantage if there is increased volatility in September in the VIX index. So I'll jump right into the trade. We're going to look at the September 18th expiration, which is the normal, when I'm using air quotes, monthly expiration in the VIX. They have a lot of weeklies and a lot of other VIX products that they've actually introduced, and by they I mean the CBOE, the Chicago Board Option Exchange, now known as CBOE Global Markets. But with that said, I don't think that they're liquid enough. I prefer to trade in the normal monthly expiration, which September 18th is actually a Wednesday, and the settlement value will be determined on the morning of the 18th. So we want to get that all out of the way. So let me talk to you about how I want to modify my butterfly on this VIX trade. Okay, So the VIX today closed right at 15. So that's just kind of fun. Anyways, it was down 65 cents on the day. The strikes that I'm going to use in that September 17th expiration is I'm going to buy one of the 18 strike call options. We're going to sell two of the 24 strike call options, and then we're going to buy one of the 29 strike call options, all in that same expiration. So it's a 1x2x1 butterfly, but if you noticed, we have an odd number in there. We bought the 18, sold the 24, and then we bought the 29. So this long spread from the 18 strike to the 24 strike, that is 6 points wide. Our credit spread that we're selling to try to pay for the long spread, that's the concept of the butterfly, is only 5 points wide. So now, in general, if we bought the 30 strike call, the butterfly would be cheaper than if we bought the 29 strike call, right? The 30 strike is further out of the money and the butterfly would be cheaper. Well, we have the VIX hanging right around the 100 level. It's a little bit below that level, but when volatility of the option contracts are a little bit high, a lot of times that will make butterflies inexpensive. Ideally, if you put a butterfly on, what you would like to have happen is you want to be correct on your forecast, and if you do, you want implied volatility to go down after that fact, and you want the index or the underlying to go towards your middle strike, but you need some time decay to get profitable on a butterfly, and that either happens with actual time decay that goes by, or implied volatility can come in. So I say all that because we're able to execute this butterfly that I just mentioned, 1x2x1, buying the 18, selling the 24, buying the 29, for a net debit of 20 cents to the account. And I just executed this trade today, or I know someone that actually just executed the trade today. It wasn't in my account. I did it earlier in the week. But with that said, they were able to execute it at the midpoint for a 20-cent net debit to the account. That means for every butterfly or every unit that was put on, it cost you $20 plus any fees to put that trade on. That also means that your max risk is going to be $20 on this trade if you're just doing one butterfly. Now, here's what the beauty is of modifying this butterfly and not going out and buying the 30 strike call, which would make it a standard butterfly. What the benefit of this is that if the VIX skyrockets and we get that nasty move that we did on a Monday in August, and the VIX jumps all the way up to 60 for a second and then comes crashing down and hung out around 28 or 30 for about a week or so, before it decided to go back down below 20. With all that said, on anywhere above 29, which is your protection on the upside, this trade will still make 80 cents. So if we go all the way to September 18th and we wake up and we look at the settlement value, which is the symbol VRO, and we see that the VIX is trading at 50, and that's the settlement value for the VIX, we still make 80 cents on this trade. All right. What's the maximum upside? Well, if you get lucky enough that you can peg where the VIX is going to be on September 18th, the maximum would be the width of the long spread, which is $6 minus the net debit paid of 20 cents, or $5.80. What's the max downside? Well, it's what you paid for it, just like a standard butterfly. We're not adding any risk to the trade. We've added a few pennies as far as cost is concerned. The standard butterfly, as I said, would be a little bit cheaper, but it's 20 cents, and we just executed at that price. So we had a trade go off at that price today. So we know that you can actually fill it right around 20 cents. So with that said, that is our downside. If the market is below 18 on the expiration, The maximum we could lose on this trade is 20 cents, and it's probably going to hold its value pretty well. In other words, if it doesn't move at all over the next, let's say, 9 days, this thing's probably still going to be trading around 20 cents. That's just the nature of the beast when it comes to VIX options. Our break even is going to be $18.20. $18, that strike that we bought, the first strike that we bought, plus the net debit paid of 20 cents, or $18.20. That means that if you're going to hold it all the way to the 18th, which just happens to be 18 days away, which is kind of fun too. So we got the VIX at 15. We got the expiration date of September 18th, which happens to be 18 days away. If the market is anywhere above 1820 and you rode it all the way to the end, well, you should have some type of profit on this trade. Hopefully, if it's right at 1820, that's obviously your break even. You'd really hope that this thing lands somewhere between 20 and 24. That would be the ideal scenario. If it creeps higher towards the 29 level, we're okay. We're okay with anything within that range because we only paid 20 cents for this. And that's our maximum risk of this trade. So if you look at the profit and loss graph and you throw this into your brokerage firm and you take a peek at it, yeah, you'll notice that above the 20 strike, it's saying that we can still make $80 on this trade. So it's a fun trade to put together. It's worth looking at, and it's probably worth mentioning because if you have traded VIX options, you do realize that the VIX, the VIX, the spot is the better term for that index, right? Is not always the driver of the option contracts that go a little bit further out in time. And so the futures contracts are what the market makers use to hedge their option contract. And I know this is a little bit advanced, but I'm actually going to put out an article that will be available under my profile, x.com, at Brian Overby, that will explain a little bit more of the ins and outs of the VIX actual spot index and the VIX futures and their relationship. But if you look at the September contract, that futures contract that expires on the same day as the monthly option contracts is trading at 1540, but it does get interesting when you get into October and November. The VIX is the futures contracts are actually above 17, and we have that big event. We know what's happening in November. We have the election, and I'm sure that's a big reason why you're seeing the futures going out further in time and closer to that date trade at a little bit higher volatility. But I love the fact that the September contract is pretty close to where the VIX is at right now. And there's just a lot of little things that make this interesting. But note that trying to predict where the VIX is going to go next is a little tough, without a doubt. There's never a rhyme or reason exactly why the VIX is where the VIX is. But I like the scenario here. You don't want to overdo it with the leverage. The fact that we can get this trade done for a net debit of 20 cents and we have a good upside amount, and also that black swan event that causes the VIX to jump all the way up towards the 50-60 handle isn't a concern with this trade. So that's going to be it for this edition of Options Playbook Radio. If you'd like to learn more about what I'm doing, please check me out on x.com. My handle is at Brian Overby, and we'll see you next week for the next edition of Options Playbook Radio. Thanks for listening.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.